Just wait to get a quick thumbs up. Make sure everybody can hear what I'm saying. Good morning, Cole. Hey, Patrick. Glad you could make it. Brent, very cool. Okay, so got my extra big sippy cup today. I guess you guys, saw it was a pretty bad week for the market, and the primary concerns are hot inflation still. So February, of course, has just been a really monster month as far as inflation goes, and that's all the January data. So it kind of started with, hi, Katie. It kind of started with the payrolls report coming in hotter than expected, and that's kind of the Fed's primary concern is wage inflation. And of course, now the services sector. So manufacturing in the US is already in contractionary or recessionary conditions, but services seems to be getting hotter. I just want to say really quick about the unemployment rate and about employment in general. You'll hear a lot about that. We had a recession early last year, and it was kind of explained away by, well, we still have a strong labor market. I have to tell you, the labor market it's like one of the worst lagging indicators that you could possibly use for the economy. So we're generally in a recession 6 months before the labor market even starts to turn down. And then the market has already bottomed and is in a new bull market, and we're out of a recession. And it takes a year and a year and a half for employment to start turning back up. So it's a really bad metric, but the concern is, of course, inflation, the wage inflation. And that was just hammered home all of February between that, the consumer price index coming in hotter. Last week we had three different things: the PPI, the retail sales, and what was the other one? Anyway, everything that's come in has come in hot. So Friday was, well, actually, we had a holiday shortened week, right? So Tuesday was a pretty ugly day. What was happening the very next day? The FOMC minutes from their last meeting were coming out. So it was ugly. Saw volatility getting bid up, people just trying to hedge it. And then we got the minutes, really nothing new in there. And then Friday, the really big one was the PCE, because the Fed's preferred measure of inflation is the PCE deflator. So just on a headline basis, PCE, I'm just looking at my notes here, came in at 5.4%. And that's on a year over year basis, and what they were expecting was 5%. So it was a lot hotter. And then the Fed's actual preferred measure within that is the PCE deflator, and that came in at 4.7% versus expectations of 4.3%. So the market has just been getting pounded. Well, it really hasn't been getting pounded. It's actually held up really well considering how much rates have moved in February. So I'm going to take my mug off of this video soon, give you guys a break from me, my goofy glasses. But in any case, last week I was talking about we still have a lot of bull flags. I'm going to pull up TC2000 here. We're going to look at that. So hopefully everybody can see that. And last week we were kind of in this bull flag, and I said last week, I feel better. These were kind of revised because as price action develops, you revise it objectively, or as objectively as you can. So we had these kind of bull flags, and I said I feel confident about the S&Ps because it had tested this trend line at least a couple times here. I wasn't as confident about like the NASDAQ 100, which only had one test. I think small cap, same. So this week we get something that is looking like a breakdown out of this bull flag, which would invalidate it if, that's what we get. But also when you're in the early stages of either a breakdown or a breakout, you really want to see like a decisive move. If you don't, you're at a high risk of being in like a head fake, or what you call a failed breakdown or a failed breakout. In this case, it would be a failed breakdown, or what you might call a bear trap. If prices reverse and move back higher, you get all these shorts in here that are suddenly at a loss, and they propel the breakout. So that's why I say, like these are these breakdowns, from these moves, you often get a really fast reversal. Just think about the concept. Shorts jumping in here on a trend line they see broken, And then all of a sudden prices just move right back in here and the shorts are squeezed, and that gives you that momentum. So from failed moves come fast reversals. I'm going to pull up a couple of the other averages, but I want to talk about, what is actually driving the market all of February thus far. And what's surprising to me is that the market has held up much, much better than it should have. Gold, and I've mentioned this quite a few times, gold and the S&P 500 are trading very similar. Not, to the percentage or anything, and not exact, but if I pull up gold real quick, gold has been getting hammered. And let me put this in blue so you guys can see it. Yellow's not very helpful on a white chart, is it? So you could see, this is the ETF for gold, GLD. But you could see, as soon as we hit this measured move, the first thing I expect is a consolidation. That's what we started in. But the very next day after we hit the measured move is when we got that first hot inflationary report from the payrolls. Gold, you can see, really kind of got hammered. I could probably do this on a normalized basis. Oh, it is normalized. Okay. So basically from right here, which is like the 3rd of January, basically the start of the year, just a little back before that, you can see gold underperforming. But the point is, the trend, let me take off the normalization so we can just look at the trend real quick. And I'll tell you what the point I'm getting at is that both gold and stocks have been trading so similarly since the Fed started raising rates. I'll go out to maybe like a 4-hour chart here. Because they are both having this exact same correlation, which is a negative or inverse correlation to the dollar and to the yields. So you can see gold over here really not acting too much like, the S&P. Over here in March, Fed starts hiking rates, and we pull this in just a little bit. And you can see how similar they trend, because they even based at the same time. So this is gold's base at like 1620 for gold futures. Same time, and the Dow actually put in almost the exact same base, kind of like a W bottom right here. So gold is acting a lot more like I would expect, and stocks have been holding up a lot better than I would expect. So let me go back to the S&P 500. And so this week we had this bull flag that broke down, and this is a psychological level. It's important. Price was really wanting to hang around that level until, what did we get Friday morning? We got that PCE report that kind of broke down below 4,000. So this was in pretty good shape for a potential bear trap. It's in worse shape now. I'm not as thrilled about the S&P. And we also had a big break in a huge triangle in the Dow. I think that's right over here. And I've told my subscribers this before. I've noticed this for a long time. Like a typical bull flag, if you go by kind of technical analysis doctrine on a daily chart, should last about 3 weeks. So the S&P and all the other averages just hit 3 weeks. I'm having a little trouble zooming out. There we go. They should last about 3 weeks. This consolidation, as you can see, is much bigger. It's from the end of November. And this is a big symmetrical triangle. And what I've noticed is when symmetrical triangles are big like this, normally it would have a bullish bias because of the preceding trend over here. If it were a triangle that was a week, 2 weeks, 3 weeks, when we're getting one here that's going on a couple months, they can often act as tops. Let's get us to the end of this chart. Wow, I don't know why there we go. So you can see that breakdown in the Dow too. These aren't great looking charts for what's been happening this week. But if we go to some of the other averages, it's ironic because the weakness this week helped confirm those bull flags. So this is a revision. See how the trend lines capture more of the price action. So NASDAQ confirmed that bull flag. This is Friday, again, that hot data from the PCE report. And generally speaking, NASDAQ is going to be the one that's going to get hit the worst on any kind of hot inflation. That's been, the theme all last year. Why NASDAQ underperformed, why mega caps underperformed last year. Then we get Dow transports, which to me are a great leading indicator for Dow industrials. And the transports confirmed this bull flag, which they hadn't as of last week. I just put in the trend lines on, like, last week I talked about how often these are like symmetrical in being parallel. So this bull flag trend line was drawn in before price even touched it. So we get confirmation there. And like with the IWM or small caps, they're still in their bull flag. So one of the interesting things I brought up last week was a change in character in high yield credit HYG, which, if you understand that, it is high yield credit and any kind of move higher in rates is going to hit it, any kind of move lower in rates is going to help it. But you kind of find the days where rates are neutral and watch what it's doing. It's kind of like a window into what institutional money is doing, because it's their kind of playground, very deep liquid product that's often used as a proxy for S&P futures. But let me just tell you on the week real quick. S&P down 2.65, Dow down 3%, NASDAQ down 3.15%. NASDAQ wasn't down much more than the other averages, and small caps down 2.90%. What I keep watching is how the mega caps perform versus the equal weighted S&P index. So anytime last year when we had a 10 basis point jump in yields, the mega caps would be 100, 150 basis points behind the S&P equal weighted index. We only really saw that 2 days so far this year. That was not this last Thursday and Friday, but the prior one. And now it's kind of moved back. So the mega caps compared to the S&P equal weight index on the week, we're only down 35 basis points, which means they're still holding up really strong. So let me go to what I said last week was most interesting to me. My philosophy is this, that changes in character lead to changes in trend. But if you're not watching the market really carefully, it's easy to miss those changes in character. So let me set up the chart here for HYG, and I'll transition it over. And I'm going to transition so you're not just looking at nothing here. This is going to be a 3C chart of HYG. This is what I call a change in character. We saw this last Friday, right in this area. HYG starting to positively diverge. And what that means to me is it's not a change in trend, but it is telling us something is happening. In any case, so HYG, real quick, positive change in tone. Now, HYG divergences are like pretty rare. You don't see them much. So this whole pullback over this whole last month in stocks has been confirmed by HYG going lower. Here's a positively divergent trend in HYG. And now we're starting to see this week HYG starting to turn. So we have the other averages not acting so well. If we take a look at HYG versus the S&P, so this is the huge bull flag. I just got it on a really short time frame. This is only my third live stream, so I'm really kind of still struggling with this, running a television studio at the same time. Anyway, changes in character lead to changes in trend. So you can see HYG is one of my favorite market-based leading indicators because it's a window into what institutional money's doing. It's been lagging. So if you remember the last couple of live streams, probably the first one especially, I had been saying, look, the stock market is holding up remarkably well in these consolidations, but the thing that's bothering me is what the bond market is doing. And I think at last week's live stream, I said, look, to be honest, I think the S&P should probably be around 3,900 given how the bond market was acting. And that includes high yield credit. So you can see it leading lower. The change in character we saw last week over here, the 3C divergence, now it's starting to lead higher. So I would put the chances of a next leg up at like about 70%. It shifts for a couple of reasons, but it's pretty much been about 70%. The kind of downgrade to my assessment is the S&P and the Dow falling out of those price consolidations, but potentially being a bear trap. And the reason I would upgrade it a little bit this week is we're starting to see some relative price strength in high yield credit versus the S&P. And this is, I got to tell you, this is one of the best signals to watch. And if you have like a really strong opinion of which way the bond market's going, just remember that, this does not like higher yields. It likes the lower yields, but you can kind of get a window on days where maybe yields are up a bit and it should be acting worse than it is, and it's acting better. Matter of fact, I wonder what HYG was on the month or on the week. Let's take a quick look. Yeah, down 0.5%. Now, it's not the same beta as, compared to the S&P, so that's not really a super fair comparison, but definitely you can see the relative strength here, despite the hot inflation. And I'm going to switch you over to TC2000. My kind of thought and feeling has been that, look, we have been getting some really hot data from January, and that's all reported in February. So that's going to drive up yields, and that's going to weigh on the market. And typically the mega caps, so the mega caps, being down 0.5% versus the S&P or whatever it was, is phenomenal. It's pretty amazing. So I'm going to transition you over to my my stock finder. Oh, I'm sorry, my TC2000. Guys, remember when I'm doing this? This isn't a plea for sympathy, but maybe a little bit. I'm kind of like almost running a television studio, switching between charts, trying to watch the live chat. It's a little bit different than I thought it was going to be. Anyway, transitioning to TC2000. Yep, we got that set right. I can get rid of this stuff over here. And I'm going to show you what my theory has been. This was really a monster uptrend. If I go to kind of like a daily chart, you could see it. And here's where it started to break. And oddly enough, we got signs in the copper gold ratio that inflation was starting to break in commodities right back here in June. And then we get this big rip up higher. Any case, the gap right here, right around, I guess it's around 4.1% for the 10-year yield. That was the first time the market started to price in peak inflation. Not saying inflation was low by any means, but peak inflation, like it had peaked and it was turning around. That's why the market is a little bit freaked out about the hotter data we've been getting this month. But like any trend, economic data does the same thing. You'll have a trend where maybe inflation is rolling over, but you will get corrections along the way. That's what I suspect we're seeing. But even if we're not, I think, a 50, 60 basis point jump in the 10-year yield over the last month or so is pretty much pricing in that hotter data. And what that hotter data has done is move the market's estimation of the terminal rate, where the Fed funds rate ends, to, I think it's up somewhere about 5.38% or whatever, but fully priced in rate hikes for March, for May, and for June at 25 basis points each. So that's kind of been the effect of all this. And I think probably the bond market is probably priced in a little bit more than what we're going to get, or what the market's pricing in for the terminal rate. So right here, this is it says 39, but that's 3.90 for TNX 10-year yield. My theory has been that, and this whole rise right here, this is exactly where the payrolls started. Watch, I'll show you. That's a Friday. See, up in the upper left hand of the screen, Friday, first Friday of the month, payrolls come out. This big gap up that started this inflationary, fear started right there Friday. But my point is that this is where we got the big gap down, where it was first like 2 CPI reports in a row confirm, and it looks like peak inflation's been hit. So my theory has been that somewhere in this area, this huge gap that starts around 3.90%, that unless the market has completely said, oh, wow, we're completely wrong, it wasn't just noise or whatever, I see this as a lot of overhead supply, but I also see it as a window of opportunity. So we've gotten a lot of hot inflation reports this week, or a couple, and we're trading just above that, so 3.95, so 5 basis points above 3.90. But it's in this huge range. I think there's enough overhead supply here. The market's already priced in the hotter data that I have a feeling rates aren't going much higher. Like this resistance zone here, this big gap of overhead supply, I think is going to start to put a cap on the rise in yields. And what's that going to help? The mega cap stocks. That's going to help the NASDAQ. That's going to help the S&P 500. It's not going to help small caps, but small caps can go along for the ride. They have no exposure to that. So hope that makes sense. I'm just going to look at the chat window real quick. Let me see what are the notes I have here real quick. Yeah, let's take a real quick look at one thing. SP 500, like I said, it did break down from this revised bull flag. Two things I want to point out. First, Yeah, possibility that this is a bear trap, being that transports are holding up in their bull flag, NASDAQ's holding up in its bull flag, small caps are holding up in their bull flag. So there is a chance here, and I would put it probably a little like I think I would be pretty close to like a 70-30 that this is a bear trap, right? And to be a bear trap, basically prices have to move back up from where all the shorts jumped in here, and their covering shoots us higher. But interestingly, what happened was we came down, and again, this SP 500, we came down. Thursday, we had a bullish hammer. So the market was like, we're ready to go as long as this PCE report doesn't come in hot. Comes in hot, market gaps down. Where's the SP find support? Hopefully you can see this dark blue line. I know dark blue is not a great choice for a black chart, is it? But hopefully you can see that and find support right there. NASDAQ 100 stays in its, well, actually just, let's see where to close. Right inside. That's not enough to get shorts to cover. You know, they got to feel a little bit of pain. But right inside this big bull flag, right? Well, where does it find support? Let me zoom in. Again, right there at the 200-day with a doji star, right? Or a star. A doji star would probably be a little bit more like this. But this is a loss of momentum candle, and it's happening right there at the 200-day moving average, the SP 500. This is a bullish hammer. So in like Japanese candlestick vernacular, think of a bullish hammer as in hammering out a low right here at support. Of course, it's got local resistance at this 50-day right above where it held for 2 days. Jump back to the NASDAQ real quick. And it's holding there too. So you could even see this consolidation on a daily chart. I prefer not to use daily charts because I want to get more information about it. But you could see this consolidation. So here's point number 2. Point number 2 is I did give some measured moves of what I thought based on the time when the S&P was a much smaller or much shorter bull flag. And I usually tend to go conservative on it. But we talked about this last week, like a measured move and comes at about 3.33%, right? So you would add that from wherever it starts to break out. But now that I see the size of this flag, and you know, there's no scientific way to do this. It's just, you know, experience and just looking at things. But when I see the size of this flag and the preceding trend, I would say there's probably a strong case to take the measured move from here. So for the S&P 500, 7.6%, you could build a case, I think, to take it from here. This is like a very liberal interpretation. Let's see if I can do this without letting go of this pointer with one finger. Jeez. All right, well, you guys get it, hopefully. This is getting pathetic, isn't it? 10%. NASDAQ, I think, has a lot more upside potential, you know. And it's also kind of got a much more vertical flagpole. So I think there is a case to make for readjusting those measured move targets. I may do that next week. I'd like to stay on the conservative side right now, but I do think there's a case building for that. Let's take a look at some 3C charts. Let me check the chat window real quick. The ES is retraced to the 60-week. Yeah, that's a good point. Limitless. That's a good point. It's funny too. I've seen this so many times that you'll find like the lower line of support of a bull flag or whatever it is, a triangle, and that support will, you know, not always, but more times than not will coincide with either like a fib level retrace or a moving average right in that area. It's a little spooky. It's a little weird, but give me just 1 second to grab a sip of water. It's a little spooky and it's a little weird, but keep in mind, guys, the correct way, I mean, I'm not going to tell anybody the correct way. My view of price action goes beyond just technical, just lines and just moving averages. Of course, you know, I love the cross asset analysis. So I'll like look at HYG versus the S&P or yields versus gold, whatever the case may be. But the point I'm telling you is Japanese candlesticks have been around at least centuries. They were used for trading rice, okay? And all these little candlesticks still have validity today. Why? Bull flags, I used to have a blast, maybe 5, 6, 7 years ago. I have one charting software that will take me all the way back to, I think, 1915 in the Dow. I would have a blast just going through those charts day by day by day. And all of these price patterns that you see now that were first started to be classified by technical technicians, whatever you want to call them, in the 1930s, late 1920s, whatever it may be, all of them came from that period. So my point that I'm getting at is, yes, we can look at this very technically like it's a bull flag, but you also have to understand that price is a reflection of mass sentiment, emotion. That's the reason these price patterns work over a century later. And I'm sure if we could, access data from before then, we see the same thing. It's because human nature doesn't change. So these are reflections. But okay, we're very bullish. We're getting a little tired here. We're going to shake out some weak hands. We're going to just take a break, like a triangle, or let's pull up a triangle real quick. Dow's not the best one since it broke down, but it's a triangle. So a triangle, I look at a triangle as being like a spring. Now, we talked about the Dow and how really big triangles can also function as tops. A good example of that was UNG. If you guys remember when we were kind of trading UNG 2 or 3 years ago, and it put in this huge triangle. I'm like, oh, it's like a little toppy. It was a top. But I look at it as a spring. Like the energy is being compressed here. It's winding up for some eventual resolution. That resolution is usually going to be by the point that we get to an apex with these two trend lines. Really strong moves will break out about 2/3 of the way to that apex. But I look at a spring, this is like a spring, where it's gathering energy, it's consolidating, it's building structure, it's getting rid of the weak hands that are people who are profit taking, all that. So I would just encourage you to try to look at price from an emotional standpoint, from understanding this is just mass psychology. It's a representation of the entire market's motions of fear and greed and all that. So this is a battle between those two forces. So let me go back to where I was. So again, we're looking at HYG. I love StockFinder because it has so many bars of data on like a 1-minute chart. But right now we're starting to lose the trend because I'm kind of stretched out to the middle. But what you would have seen was 3C tracking a little bit below price, not quite this low, kind of leading it lower right into this area. Then that divergence that last Friday. So that was the change in character I was talking about last Friday. And now we're starting to see a price change in trend. But I want to show you the other averages real quick. SPY. Let's zoom this in. So here's our little area where, prices have come down. SPY has held this nice positive divergence on this 1-minute chart. So QQQ, let me show you real quick. And this one's kind of an interesting one to me. It's got a positive divergence that is starting as it's pulling back in here. So that's the power of 3C, is its ability to contradict price. So when it's moving with price, I have no reason to expect the trend to change. When it starts diverging with price like it is here, that's starting to tell me, look out for a change in trend, which we see here. So you can see 3C really did lead prices much lower, and now it's positively diverging. In QQQ's case, I think it's an interesting divergence. I think there's one on 2-minute too. And this is another thing that when a divergence strengthens, it will move to or migrate to longer time frames. They have a little bit less noise, a little bit more trend. This is kind of interesting to me, and I'll show you why real quick. If you just look at how 3C looks on this 2-minute chart versus QQQ, then we'll go to my mega cap index, right, versus the benchmark S&P. Very, very similar trend over here. The mega cap index is just my own personal bunch of mega caps in there. They're all equally weighted. There's no cap weighting that you see in the S&P 500. So kind of interesting that those two look very, very, very similar. Let's go to like IWM. We've got positive divergences all over the place coming into these. So this is a factor to me that supports a possibility that is leaning a little bit more likely than not, especially now that I'm starting to see HYG acts better, and we see the 10-year now at that 3.90 level where I think there's resistance. So IWM, Dow, I'm not excited about, I have to be honest, but we do have the same positive divergence there. Now, the problem is not this past Thursday, but the Thursday before that. There's some really heavy selling, and that was one of only 2 days this year where I saw mega caps act like they did the prior year, which means instead of being 10 or 15 or 20 basis points around the S&P 500 equal weight index, like 100 basis points, below it. So that was just that one Thursday afternoon and then that Friday. But what happened on that day was we did get some pretty serious damage on these 5-minute charts that I've been using to track this trend of the rally. If you can kind of visualize a bull flag right here. So 3C is actually leading price into what it actually eventually becomes, a bull flag. The part that is kind of alarming was this Thursday right here, where there was some serious damage done. There was some serious selling going on there. Now we're starting to see, this is like a relative positive divergence. This over here is a leading divergence. You see this, it's leading price higher and then price boom, like that. So relative would be the same as this, just relative to price. Leading is a much stronger divergence. So if we kind of zoom in, there's a relative positive divergence here. You can see the relative weakness right here with 3C. So there is a case to be made that we're seeing a little improvement on these charts, but this day did some damage. I didn't like it a lot. And QQQ is the other one that has been really strong with a really good trend. Here is the change in tone in late December when we had this really mediocre kind of flat range and it was dull market. See the positive divergence? So QQQ had been the dog of last year, and now they're rotating into that. So there's a lot of tax selling that was going on, but somebody was in there with some money and they were accumulating this little range, okay? And we had another bull flag right here, and there's that Thursday damage done. So there is some damage on these charts. Can they change quick? Yeah, they can change in a day. I'd prefer that didn't happen, but this is all pretty much from that one Thursday. So let me pull up the chat window again, see if anybody's got, what is 3C? Okay, so it's a proprietary indicator that I created, but it's based on Don Warden's time segmented volume. So it's a money flow indicator that has an ability to contradict price. So it takes, some indicators just look at price, like momentum oscillators, MACD or whatever. This looks at price and volume, and it has like a look back period. So you could call it kind of like a relative, I don't want to say relative strength indicator, but it looks back at where price was, what volume was like, what that trend was doing, and then compares it to now, and it moves this line. So Don Warden, I think it was in the 1950s. He's the guy, by the way, who started the company at Telechart and StockFinder, this program. I can't remember what his was called. Maybe it was called Tick Volume. Anyway, it was the first money flow indicator that had been created. He took it and he sold it to Wall Street, and Wall Street was using it, so he didn't make it public. And then this other guy, again, I can't remember the name, but they're all indicators you've heard of. He came out, he made his public, and he got, kind of recognition and credit for it, whereas Don Warden was just making a ton of money by selling it to Wall Street and keeping it quiet. But he's kind of the pioneers or the leaders in tracking money flows. So, what we're looking for is 3C is moving with price, then it's confirming the trend, saying, there's nothing too unusual going on. It's kind of what you see, what you get. When it diverges like this, that's kind of a sign of, okay, well, there's money coming out, or it could even be distribution. So if you're an institutional hedge fund and you want to take profits, you don't want to sell into price weakness, because that's just going to get more price weakness at the size that they trade. So they want to sell into price strength as price is moving up, right? And that's where you'll start to see these kind of divergences. Or like I said, with like it over here, right? They don't want to be buying prices that are moving up. They want to be buying price weakness. They want to be buying on a discount. And part of the reason is that their positions are so large, they could move the market just with one transaction. So they'll break it up into a whole bunch of small transactions. And basically, that's what 3C is looking for, or what 3C is tracking. But it is a version of Warden's time segmented volume, except time segmented volume runs is as an oscillator, whereas 3C runs as a cumulative indicator. So kind of like with price rather than in an oscillating window down here below, like maybe like MACD or something. That's another example of an oscillator. Take a look at the comments real quick again. Okay, Adam. Still a series of higher highs and higher lows since the October lows, despite a lot of bearishness around. Yeah, you're absolutely right. And this is one of the things that like I have to do because, if I'm looking at the same, this triangle, I've been looking at this for 2 months, you don't realize sometimes that there's like a subtle bias in it. So a lot of times what I'll do fairly regularly, what I'll do is I'll take off the trend lines, right? And just look at, just like kind of let my mind go blank, kind of blur my eyes and just look at the price trend. Let me get a 4-hour chart so we can actually see the entire price trend without these candles getting real small. So here's our October low. And this is why I like, intraday charts too, because you can't see the inverse head and shoulders very well here on a daily chart, but it sure shows up on, a 60-minute or whatever. But as he was talking about, I think 4 hours is a little too long. Let's go 2 hour. But what he's saying, absolutely. So this is what I was making a really big deal about, a big stink about, when the Dow had led this first half of the rally off these October lows, and it was up 20%. And the financial media are saying, oh, the Dow's in a new bull market. I consider a bull market or bear market the primary price trend because every stock has a different beta. A 40% move for Tesla could be well, I don't know, 40, let's say a 20% move for Tesla could be a simple pullback on its chart. 20% move for Walmart would look horrible. They have different betas. So it's a really subjective thing to say, oh, 20% off the lows is new bull market, 20% off the highs is bear market. But let me just see who that was again. Was it Adam? Yeah. What he's saying is true. Higher highs, higher low, higher high, higher low, higher high, higher low. So I would consider this probably on the verge of an intermediate trend and maybe sub-intermediate to intermediate. So if you want to find out about that kind of stuff, like you have to look back to like Dow theory and all that, but you can categorize the trends. A lot of times you can use moving averages as a quick proxy. So I would say like a 50-day moving average would be, its direction would be kind of similar to an intermediate trend, whereas like a 200-day would be more like a primary trend. So if you don't want to go through all the hassle, but he's absolutely right in the way he's looking at price. Let me just pull up the moving averages for you so you can see. So primary trend represented, right, as I was just talking about, by the blue 200-day is moving down. Over here, the 50-day, is not like blasting off, but it is moving up. So this to me is like I said, borderline, and I wasn't even making that assessment on the moving averages. I was just making it on what I see in price. This to me is borderline, like a sub-intermediate to an intermediate uptrend, which back in September is what we were looking for. And we can see it really well here in IWM. My call wasn't that we were going to make a bottom and a new bull market. My call was that we would move from a primary downtrend, which is basically lower highs, lower lows, just the way he pointed out that this trend we're in now is still higher highs, higher lows. But if you look at IWM, my call was that we were going to move more lateral in an intermediate trend. If you look at IWM, that's what it's doing. It's moving to the side, lateral in the intermediate trend. So that was kind of my call. That's pretty much all I've been looking for. I do think at some point that we, head into recession, after all the Fed pivot, happiness is over. And I suspect that, yeah, we'll kind of reassert this primary downtrend. But right now you see golden crosses in like a lot of the averages where the 50-day crosses above the 200-day. There's a death cross where the 50-day crosses below the 200-day. They're just like quick, dirty ways to look at a chart and say, you know, what's the deal here? What's it doing? So you can go through a lot of these. You'll see the same thing. Now, NASDAQ that lagged really bad last year, it doesn't have it because it was such a horrible performer. It is the one that is starting to lead the second stage of the rally, which you can't see here because there basically was none, you know, but you see it in the Dow and S&P and all that right over here. But yeah, it hasn't crossed up yet. So just to give you a quick, I'll pull up the Dow real quick just to tell you show you what I'm talking about. You know, pay attention to this area from October. This is like really weak because what was leading the rally were cyclicals and the Dow. So you can see it right here. So my call was that would flip as we moved into the new year, and that the Dow would start to underperform and NASDAQ would start to outperform. Let me just take a look again at the comments real quick. Okay, I hope I answered the question about 3C. Great observation, Adam. FANG minus Amazon are in that bullish consolidation as you show on NDX. Yeah, because the weight, you know, these are cap weighted indices. You know, I put it this way. I remember a time, I don't know how long ago it was, over 5 years ago though. I remember a time where I did some quick calculations and everything. I was looking at the NASDAQ 100, and to illustrate the point, I said, well, if we made it the NASDAQ 51 and there were 50 stocks and then Apple, those 50 stocks could be down altogether, like cumulatively on average, like 2%. And if Apple was up 3% on that day, then the NASDAQ 100 would have closed up 1%, despite 50 of the 51 stocks being down. That's how much weight they have. I mean, Apple doesn't have that much weight anymore, but at the time. So that's why when I compare how the mega caps are doing to the S&P, I always look at the S&P equal weight index, not the cap weighted, which is the benchmark that you always see. Looking again here, Brent, I'll have to look at those closely if you want to get in touch with me earlier next week. I haven't been looking at them in terms of the individual stocks too much, except once in a while I'll check 3C if I think something's moving intraday. But of them, yeah, I would have to really look. And, you know, I don't feel comfortable just blurting out an answer or trying to do the analysis on them right now. But my personal way I like to trade is, you know, you can make a lot more money. You can also lose a lot more money, you know, trading in an individual stock. What I like to try to do is minimize the risk of things like, hey, maybe this sector is in rotation. It's the one driving everything and the market's in the right place. So I'm going to pick my favorite stock in that sector. But you still have individual risk to that stock. You know, did the CEO do something funky or their earnings or whatever? So I try to minimize things I can't control, which is kind of why I like usually using ETFs more. That's not to say that's the best way to do it by any means. It's just for me, what I'm trying to accomplish is to control as many things as I can, or just not have open risk that, you know, could pop up at any moment. So I like the ETFs a little bit better, but there's no doubt you can make more with an individual stock. Patrick, I don't know. I know there's some quants that are tracking that stuff, but that's like really out of my league to be able to track that kind of stuff. Can you show how you enter a trade on SPY, for example, including stop loss? Okay, so what I would do doesn't mean that's what you should do by any means. We all have different. I've got all day to watch the market, but I've also got, and I had to decide this years ago, is my priority when I'm doing two things, when I'm trading and I'm informing you guys. If I'm in like a quick day trade, you know, then I've got to pay a lot of attention to it. And I'm not doing you a service by not communicating what I'm seeing, but, oh, I've got to take care of my stock first. So I don't enter any trades that I feel like are going to take my attention away, that they need that much attention, that, you know, I just had to make the decision. My priority is my subscribers over what I trade. So that has changed how I trade over the years too. So for S&P 500, it would depend. for me, if we see rates kind of top out, 10-year around that 3.90 level, if we see high yield credit continue to lead higher, if I see the 3C divergences start to improve, especially on those 5-minute trend charts, and then I see maybe, something like price starting to move back in here, and I'm like, okay, that looks like it's going to be a high probability bear trap. I will either, you could enter here. I wouldn't like to enter here just because this looks a little bearish to me right here. So maybe we come down again and test that 200-day on Monday. But what I would probably do is get in somewhere right around here. And you could set your stop loss in a variety of ways. But I would encourage you to do a little research on like the 2% rule. Actually, I would encourage you strongly to do research on 2% rule, because the best traders I know, and I'm not one of the best traders I know, I'll tell you that, is the thing they have in common is they can be wrong more than they're right, and they make money because their risk management is tighter than a clam with lockjaw. I mean, they don't take anything personally. It doesn't feel good to be on the bad side of a trade, and a lot of times like, oh, I'm just going to stick with it because I see, I draw this trend line here, and there's a lot of bias, a lot of things that can go on, but yeah, stop loss. So I would want to probably get in somewhere over here where I see the potential of this, becoming a bear trap, and it's going to slingshot momentum to the upside. And then as far as a stop loss, I would use the 2% rule. So if I want a stop loss at 4,000, and I would always put it below 4,000 because levels like this get just tested and run all the time, like we see over here. I would put it a little bit below that, but my risk management would be placed on the 2% rule. So if I want a wider stop, I take less shares. If I have a much tighter stop, then I can get more shares. But that 2% rule is always like deadly important to me. So, if I say, hey, well, I want to put my stop down here, say I'd buy 10 shares with a stop at 4,000 when price moved up here, right? If I want a much wider stop down here, then it might come out to something like 4 shares, which I'm just using that as an example. The more risk I have, the fewer shares I can take on, because that 2% amount that I'm willing to risk has to be reflected in how many shares I have, and that depends on how wide my stop is. But with a situation like the S&P, I would be looking for confirmation of a bear trap here. Maybe I'd get a few shares down here and just see what happens, and if it starts moving up more. I'm not opposed to, I never want to chase price, but I do want price to prove itself first. So I hope that kind of answers your question, but I would really, really strongly suggest at least looking into the concept of the 2% rule. Let's see, what else do we have? I'm seeing clear divergence in VIX, VVIX on the weekly. VIX uptrending, VVIX downtrending. Yeah, you know what? What chart do I have up? Damn, I've been talking the whole time with the wrong chart. I'm so sorry. Transition. So again, real quick, what I was saying was I would wait for price to make a confirmation right here. And if I wanted, a tighter stop right below that trend line, I could take on more shares. If I wanted a little bit wider stop below 4,000, I could take on a few less shares. If I wanted a real wide stop below 39.40, then I would have far, far fewer shares, okay? Because that 2% risk would be the determining factor of how many shares I can get once I know where I want my stop. Guys, I am so sorry. I did that last broadcast, and like I said, it's like running a television studio here. But the last question I want to get to there was, VIX, VVIX. So what I've noticed is VVIX tends to lead VIX in terms of relative strength trends. So I'm going to pull that up. I'm just pulling up a different chart here, and I'm going to show you the way I kind of look at this. But yeah, volatility of VIX is VVIX. And what I've just noticed is when I see a relative strength trend in VVIX, I kind of almost am looking for that same trend to emerge in VIX. So here I'm transitioning. So what you're looking at right now, and if you're one of my members, then you know this, is just my little quick and dirty view, first, this is the S&P 500, a volatility's term structure. And what I was saying earlier this week is a reading above 1.0 will paint these bars white. Okay. So this is just where volatility's term structure has gone into inversion or backwardation. And it's kind of, it's like a panicky moment in the markets. Now, unless you're in a full on crash, like, the COVID crash, more often than not, when you see this, it's like a really strong oversold kind of signal. So you'll see a lot of these at little market lows here and get little bounces, or over here, get little bounces. Over here, again, painted white, get a little bounce. So we got really close to that. I think it was Thursday. It's got to be over 1.0. I can't remember if it was Thursday or Friday, but it was sitting right at 1% at one part of the day. So if that had printed, I would say, hey, this is starting to look like a real high probability, very deeply oversold signal. You don't need this for trading. Obviously we don't get them here, we don't get them here, but when you do see it, it's an edge. So what I want to do though was pull up VIX, and I'll show you what I do. So what you're looking at is the SP 500 on a 2-minute chart, and you're looking at VIX in blue. So what I do is, this is what the chart would normally look like. S&P down, VIX up. It's kind of like a Rorschach painting, like you fold the paper in half with paint in the middle and you get some kind of weird symmetrical pattern, right? So VIX typically trends opposite of the S&P 500. So what I do to look for relative strength trends is I invert VIX, okay? So I can see over here, we're starting to see some relative weakness in VIX, how it's trending down here versus the S&P. So this is the S&P actually lower. Normally VIX would be higher, but you can see it's not. And what has kind of led this is VVIX. Let me pull that up real quick. I hope you guys didn't hear that loud ring in your ears. Here's the relative strength trend in VIX. Here's the weakness, or I'm sorry, in VVIX. Here's the weakness in the market. But that VIX relative weakness I was just showing you was right in here. VVIX started to lead that first. I'll just jump back to VIX real quick so you can see it. But this is what I'm talking about when I say, gosh, I hope you guys aren't hearing that bell. I know you are, though. I'm sorry. You can see the relative weakness just starting in VIX. So I like to use VVIX as kind of a forewarning of what's coming with VIX. And a lot of times, we're seeing a lot of hedging before these big inflation reports come out, and, VIX will get bought up real sharply right before it, then it'll get dumped as soon as the report comes out. But I'm looking for a trend and not just, something that happens on one day. Let me just jump back to the questions here. Relative strength, and it's looking quite dire for bulls, just my 2 cents. Yeah, there's some things out there that aren't looking fantastic. I mean, I would really prefer that the bond market and the equity market weren't sending different signals through most of February. And the whole point of that 39.0 level for the 10-year yield is kind of like, well, we've kind of already discounted 50 or 60 basis points there. So maybe we're done with that discounting. Yields are going to take a break and give stocks a window of opportunity. But I'm not, after that, I'm not real confident. We'll just have to see what happens next. What platform are these? Okay, so the platforms that I've showed you so far are TC2000 from Warden. The one with 3C, the orange lines, is Stock Finder. I'm not sure if they make that or if they still have that available. You might be able to get it. They replaced it with TC2000. I like Stock Finder way better, mostly because I can get 5,000 bars of intraday data. And I like to see that on, when I'm looking at trends, whether it's 3C or this chart I have up of VIX. Let me just double check that I do have this chart up. Yeah, okay. Like I told you on my end here, it's like running a television studio. Yeah, the HYG chart, this is, so basically what I said to my subscribers was like, I would still keep the probabilities of another leg higher around 70%. I would downgrade them a little bit because of the S&P and the Dow breaking below their price patterns. which can still be a bear trap, and that could be a very bullish thing. But we need to see some more evidence of that. And the reason I would upgrade it back up to 70 is that the one thing I was pointing out last weekend was a change in character in HYG on its 3C chart. We had not seen a change in the price trend. Now we're seeing that relative strength in the price trend. That's the bell I was talking about. Hopefully you didn't hear. You could see HYG just leading, the S&P lower until about this point. So we're looking at HYG in blue and the S&P 500. Nothing's inverted. And you could start to see this relative positive divergence. And that is why I would upgrade it. So this continues, then I get more bullish. So I'm always trying to look at this in a matter of probabilities, what I think is most probable. Why? How does one thing kind of, I guess it's really subjective between people and how you trade, but that's how I look at things with probabilities. Let me see. Any other questions? I don't have a 3C chart for DXY. Sorry, Patrick. They changed, I can't remember which index it was, but they want to charge like a ridiculous amount of money so you could get the dollar and small caps. I was like, yeah, I can find other ways to look at those. Yeah, Stock Finder does belong to Warden. TC2000 is Warden. I also use TOS. The only reason I use TOS mostly is just to look at futures, and I have 3C on there as well. But let me talk about one other thing real quick. Gold. So we kind of looked at the price trend of gold versus the S&P 500 and how they've been kind of tracking and trending similarly since the Fed started hiking rates, which is odd. I know a lot, well, not a lot. I know a couple old timers, they're gold bugs, talking about, people in their 80s. One is like in his 90s. He was an economist and he wrote all kinds of manuals and textbooks for colleges in California. But they're huge gold bugs, and they've been waiting for inflation because back in the 70s, gold was an inflationary hedge. Gold's acted horrible during this whole inflation event. I asked him, why do you think that is? And he's like, I have no idea. Oh my God. The only thing I know for sure is that gold is trading inversely to the dollar and to yields, or more specifically, real yields, which is nominal less inflation. So I think gold's down 5 weeks now. Gold, that's GOD. You can see the bear flag. Again, I said, look at it compared to NASDAQ. And I got to move NASDAQ's price chart to the revised. NASDAQ, bull flag, right? We go back to gold. We have a bear flag. So yeah, I think we have another 2% down. There is the first flagpole, bear flag, and this the second leg down. So I think it's got about another 2%. I do think, Grow, I do think that we will get there. And I think the probability is that we're in, I kind of view the market right now in 3 phases. The first phase is kind of what you might call the Fed pivot, although they haven't really pivoted, but they've gone from super hawkish, raising 75 at every meeting, to a step down to 50 and now 25. So we've got probabilities priced in for March, May, and June of 25 basis points each. So one of these days, somebody's got to remind me before I do another webcast. I have a chart with notes on it, and what it shows is like just about every single counter trend rally in a bear market, and some of them are amazingly strong, has something to do with the Fed. The Fed either had a change in course. They stopped. They went from rate hikes to stopping, hiking rates, or they cut rates. But when you look back, and I look back at the Dow all the way back into that whole 1920s, all the way back then, and I made little notes. I went, look, what happened on this day? What happened on this day? And I got to tell you, like 80% of the kind of trend rallies we get has something to do with the Federal Reserve changing something a little bit. So my view has been phase 1 is that, let's call it the Fed pivot, even though the Fed hasn't pivoted. They just kind of done a step down. They're less hawkish. So peak inflation, less hawkish. Phase 1, market rallies on that. Okay. Phase 2, the bill comes due for fighting inflation, which is all the rate hikes. So those 75 basis point rate hikes, not all of them are in the economy yet. Monetary policy lags about 6 months. So probably by the end of March, those will be hitting the economy. So the stuff that's in the pipeline that's coming is going to make the economy worse. Okay. So phase two is the bill comes due and we look at moving into recession. The Fed will at some point have to transition and start cutting rates. One of my personal beliefs is, and I've said this, going back to over 10 years, if you look at the Fed funds rate, it's done nothing but go from 20% down to zero over the last 40 years. They need, on average, 500 basis points of rate cuts to deal with a garden variety recession. That means they have to have the Fed funds rate at least 5%. So one of my kind of things has been like, look, the Fed slammed the interest rate, the Fed funds rate down to zero for 7 years. After COVID, they did the same thing. They slammed it down to zero. They have no room to cut without going negative, and they're not going to go negative, right? So the only way they've been able to loosen conditions more is by buying assets. So I think it's something like 500 billion in assets that they purchase, whether that be treasuries or whether it be MBS or whatever, equates to about 0.25% rate cut. So that's why you see the Fed's balance chart, our balance sheet, go from 800 billion in like 2008 to over 8 trillion now. So phase two, recession. Market turns back down. Phase three is going to be when everybody's bearish. Nobody likes stocks. Maybe the Fed has already pivoted. Maybe they've done 1 or 2 rate cuts. Phase three, I think, is the start of a new bull market. So I think we're late stage phase one right now, if that kind of helps clarify where I think we are on this map. I'm reading the comments, guys. Hey, Ken. Dominant price volume relationship. Yeah. So Ken, Lou asked a question here in my daily reports for subscribers. I talk about the dominant price volume relationship. I have 3 conditions to classify a market as like one day oversold, one day, or one day overbought. So the 3 conditions are: first, a majority of S&P sectors have to be either up or down. I'm not talking about, like 7 out of 11 are down. Like at minimum 8 of 11, 9 of 11, 10, 11, all of them. So that's the first condition. So if we're looking at a one day oversold dynamic, the majority of S&P sectors have to be down. Then the next thing, the second one, is the NYSE decliners have to be at least 2-to-1 over the advancers. Sometimes they'll be 4-to-1, sometimes, even higher than that. But if they're not at least 2-to-1, then it doesn't qualify. So if we get at least twice as many decliners than advancers, that fulfills the second condition. Now, the dominant price volume relationship he's talking about is a scan I wrote. I would show it to you, but I do not have that chart linked up to this software. I could put it on the daily wraps and show it to you. So what I do is I take basically the 4 averages that I track. Which actually, with that scan, it's the Dow, the NASDAQ 100, the S&P 500, and I also have the NYSE, but I don't pay as much attention to that. So I created 4 different conditions for the component stocks. So let's say the Dow, 30 Dow stocks, right? I have 4 scans. One is looking for, did a stock close up on higher or lower volume? Those are 2 different conditions, right? Did a stock close down on higher or lower volume? So you have 4 potential probabilities. This isn't the Dow that I'm looking at. It's the component stocks in the Dow. And the scan takes a little while to run. What I look for a one-day oversold condition is for there to be a selling climax. So you have a vast majority of stocks down, but they're down on rising volume. So it's kind of like the market puking, like, ugh, God, we got to get all the, and that I view as kind of like a selling climax. And I would call that one day oversold. Conversely, if all 11 sectors are up and if advancers are at least 2-to-1 over decliners, and the dominant price volume relationship is, first, if it's close up, volume up for the majority of the stocks, that's very bullish. If it's close up volume down, that's less bullish. That's actually the least bullish of the four. So I look at all three of those conditions: sectors, the internals of the NYSE, and then scans of all the stocks in those three major averages. So for a relationship to be dominant, I would say, in the Dow, I would be looking for at least half of the stocks to come in that one particular category of the four. So I hope that makes a little sense, Ken. I see Monday as critically important. Like you limitless. I'm trying. Oh my gosh. This is on my third web or web live thing. I've always seen the thing go live, and I thought, oh, okay, let's do that one time. But I could only use my web camera, and who wants to look at me for any period of time? So to be able to share charts, I had to get this whole other software that is like running a television studio at the same time. But yeah, I agree. Monday is going to be really critically important. So let me just kind of wrap this up. But what I'm looking for is, let me pull up, let me switch you over to Stock Finder. So what I'm looking for is basically more relative strength in the trend. So you can see S&P trending down here, HYG starting to trend up. I'm looking for more of this. The more HYG leads, the stronger the signal, the higher the probabilities. This is a major change for me because all of this month, all of February, HYG has either been tracking lower or leading lower. And this is why I was saying, look, I think stocks are holding up much better than the bond market suggests they should be. And this is a pretty major step. That's why just the divergence last Friday was kind of the subject of my whole rant, or what I thought was most important. And it was still trending down. So that was changing character. I want to see the 3C charts improve, especially the SPY, and especially on QQQ. So we do have a divergence here, getting kind of interesting, right? This makes a stronger case for that bear trap that I was talking about. I want to see that continue and migrate to stronger time frames. Same with QQQ. I'm more interested in how QQQ acts because that's where I think we're going to get the leadership for any next leg up. Other things that would be beneficial, I'd like to see semiconductors outperforming the tech sector. I'd like to see small caps outperforming the S&P 500. I'd like to see Dow transports outperforming the Dow. So all these are like little factors I'm looking at. I really want to see, and we've gotten hints of it here and there, of treasuries kind of finding some solid ground underfoot, treasury futures, and yields to either cap and start to consolidate or to come down, because I think that is the window of opportunity. The market's just been discounting that hotter January data that we've gotten all in February. But if that's priced in, and that's kind of what my theory was, like this 3.90 level and above, should be some overhead resistance. And, you got a 50 or 60 basis point move this month in the 10-year yield. Then that extra hawkishness of an extra 25 basis points or whatever should be priced in and give the stock market, especially the mega caps, some breathing room to rally, if that makes sense. Monday, as critically bullish scenarios on TLT. Yeah, bond. I got to tell you, if you've got the time and if you've got your tools that you analyze the stock market with, I would do the same with bonds, whether it's treasury futures or if you're using the cash market, you use like IEF, the 7 to 10 year. So that's kind of around the belly. And like something like TLT would be 20 plus year. It's kind of, I would probably pay more attention, although TLT's got it's a much deeper, more liquid product. But I would pay attention to those. And if those start looking bullish, then that's going to help the stock market. Okay, guys, I think that's it. If you guys have any other questions, I'm going to post this video at some point as a video. I'll probably edit out the little parts where you guys are like, hey, I can't see your screen. Very sorry about that. And it's the third webcast, so hopefully we'll get a little better with that. So I am going to say thank you very much for joining me, and I am out.